Good afternoon, everyone, and welcome to Inside ETFs University, our Canada edition. We'll get started in just about 1 minute as we allow everyone in the queue to go ahead and get dialed in. Please bear with us. Thank you. Hello, everyone, and welcome to our Inside ETFs University webinar series. Today, we kick off our 5-part webinars with our ETFs 101, Understanding and Evaluating ETFs, Everything You Need to Know. My name is John Swolf, and I'm the CEO of Inside ETFs and your host for today's webinar. Before I turn the webinar over to our presenter, Matt Hogan, I did want to take a minute to thank all of you for joining us and cover a few quick housekeeping items. At the bottom of your audience console are multiple application widgets you can use. If you have any questions during the webcast, you can click on the Q&A widget at the bottom and submit your question. We will try to answer them all live during the webcast, but if a fuller answer is needed or we run out of time, our speakers will do their best to follow up. We do capture all of the questions. You can expand your slide area by clicking on the Maximize icon on the top right of the slide area or by dragging the bottom right corner of the slide area. If you have any technical difficulty, please click on the Help widget. It has a question mark icon and covers most of the common technical issues. An on-demand version of the webcast will be available approximately 1 day after the webinar has concluded and can be accessed using the same audience link that was sent to you earlier. As I mentioned, today's webinar is the first installment of our Canadian ETF University series. Over the course of the next 5 weeks, we will cover everything from ETF basics to the more complex ETFs like smart beta and active ETFs, as well as fixed income ETFs, and we'll talk a little bit about how you can trade ETFs effectively. But as the old saying goes, you have to walk before you can run, and that's exactly what we're going to do here today. Over the course of the next 50 minutes or so, we're going to explore the ins and outs of ETFs, leaving you with a core working knowledge of ETFs, what makes them unique, and why these are such a great tool for investors. I am truly excited for today's webinar, as I could not think of a better presenter than Matt Hogan to kick off our ETF University. Matt has spent over a decade in the ETF industry classifying, dissecting, and evaluating ETFs, helping investors better understand how to use them and how to be better invested with ETFs. For those of you that don't know Matt Hogan, he is the chairman of Inside ETFs, the world's leading ETF conference and webinar company. Matt was previously the CEO of ETF.com, and he has co-authored the CFA Institute's comprehensive guide to exchange-traded funds. So as you can see, we could not have a better presenter on the line with us today. So with that, I wanted to turn it over to Matt. Matt, it's all yours from here.
Thank you so much, John, and hello, everyone. Thanks for joining me for this hour to learn about ETFs. As John said, we're going to walk through this hour so that you can run with the rest of the webinar series. Really excited to be working and speaking with a group of advisors who are interested in what ETFs can do for their clients, and really excited to be engaged in the Canadian ETF industry, which is one of the most vibrant, exciting, and fast-developing geographies in the ETF space today. So just delighted to be here. I wanted to start with this, which is a big picture view of why we're all gathered here today. We're gathered here today because ETFs are transforming investing around the world. This is a chart of global ETF assets. You can see they're measured in U.S. billions of dollars on the left-hand side. And you can see that since 2003, ETF assets have gone steadily upwards and globally now peak around $5 trillion, more and more every year. I call particular attention to the jump between 2016 and 2017. Last year's growth in the ETF industry globally was unmatched in its history, both in terms of net flows and appreciation, and that pattern has continued for the first 2 months. So we're seeing massive growth. I think importantly, this growth is repeated in every geography you look at. This is my home turf, the U.S. You can see assets rising from nearly zero in 2003 to $3.5 trillion today. This is Europe, where again you can see assets going from literally zero in 2003 to over $800 billion today. And again, I'd call out that massive jump between 2016 and 2017. This is Asia ex-Japan with the same story. This is Asia-Japan. You can see the massive growth repeating itself. And of course, the reason we're here, this is Canada. Canada has gone from a nascent, quiet market in the ETF space dominated by a single provider to, as I said, one of the most vibrant corners of the ETF market in the entire world. Flows, yes, last year were up 50% from any previous record, over $25 billion in net flows. Really remarkable considering we hadn't topped really much more than $15 billion in the past. So massive growth. And I would say that you ain't seen nothing yet as far as it comes to the Canadian ETF market. This is a great slide by the CETFA, which looks at when different providers entered the ETF market in Canada, tracing back to 1999 when it was just iShares. And you can see that there's been a steady trickle, a handful of acquisitions, and then sort of a Cambrian-like explosion in 2016 and 2017. 2017 alone saw more than 10 new issuers enter the ETF market, one significant acquisition, and that was after 2016, which had 6 new issuers enter the market. So this is a market that is growing fast, evolving rapidly, and as I said before, hugely exciting. BMO came out with this note not that long ago, expecting Canadian assets to triple to over $400 billion by 2023. I think that's probably on the conservative side, given what we've seen in terms of flows in the past year and given what we've seen in terms of the entry of new players into this space. The Canadian industry does remain concentrated. You can see that BlackRock and BMO have the lion's share of assets in the industry. But one thing I would call out is that some of those smaller slivers today are very big firms with very big ambitions. Vanguard, Horizons, RBC, First Asset, PowerShares. These are potential giants in the ETF space, and the reason they're getting involved is not because they think they can raise $1 or $2 billion, but because they think they can raise tens and 20s and 50s of billions of dollars. And I'd say it's paying off. If you look at the fastest growing ETFs to launch this year in Canada, they are not from the big two, iShares and BMO. They're from some other players, Mackenzie, Vanguard, Sphere, Redwood, Purpose. You can see real diversification, and these are companies that are being rewarded with net inflows from investors just in the first 2 months of this year. So you can see that investors are open to new ideas. So I think the ecosystem is extraordinarily vibrant. Investors are really taking hold. Flows are coming in, and people ask me why. And when they ask me why, usually, if you ask me or anyone else, you come up with a list of benefits like this: that ETFs are lower cost than their competition, that they can have some tax advantages, that they offer intraday trading, that they're transparent, and that they keep getting better, that there are economies of scale. As the ETF ecosystem grows, ETFs get incrementally more efficient and more effective for investors. But the funny thing about this list, and the reason we're gathered today, is that while everyone can state these as the key benefits of ETFs, a vanishing fraction of people can explain why ETFs are lower cost, why they can be tax efficient, why they're so popular for intraday trading, why they have transparency advantages versus mutual funds, or in essence, how do ETFs really work? And what we're going to do over the next 10 minutes or so is walk through the core underpinnings of how ETFs work. These slides can be a little complex, but I'll promise you that if you can follow along what I'm talking about in the next 10 minutes, you'll understand essentially everything you need to know about ETFs, and you'll have the framework for evaluating what makes a good ETF and what makes a bad ETF, and which ETFs you should use in your investments. So that's a big promise. To back up that promise, I want to start way back in the beginning and not even talk about an ETF. I want to talk about mutual funds. And I want to talk about the basics of how a mutual fund works, because a lot of people frame ETFs as compared to mutual funds. So let's set the stage. Most people buy mutual funds, but let's imagine that you and 3 of your friends each had $10,000 that you wanted to invest. But you didn't have the time or the energy or the wherewithal or the resources to go out into the market and pick the stocks that you wanted to buy. So instead, you decided to pool all your money together. You each put $10,000 into a central mutual pool. That's where mutual comes from. It now has $40,000. And to keep track of who owns what, you're issued shares, in this case, 100 shares at a net asset value of $100 to represent your $10,000 investment. And then instead of managing that money yourself, you'll hire a professional money manager to go out and pick the stocks and put your $40,000 to work. Now let's imagine that manager does a great job and that $40,000 becomes $80,000. The way that's accounted for is that your shares are now worth $200 each. So you now each have 100 shares at $200 each. You've doubled your money. Now the beauty of the mutual fund structure is that one person can decide to leave without harming anyone else in the fund. In this case, the gentleman in the gray suit decided he wanted out. He turned in his 100 shares. He got $20,000 in cash, and everyone else stayed invested. The pool now had $60,000. Now, if someone else wants to invest, they can come in too. In this case, someone had $10,000 to invest. Instead of getting 100 shares like the people originally did, they only get 50 shares because the shares have appreciated in value. But now the fund has $70,000 to invest. It keeps track of who is who. Now, in practice, most of us don't start our own mutual fund. We buy existing mutual funds, but the process works similarly. Let's say you want to buy $10,000 of a given fund. You either call your broker and tell them you want to purchase this fund, or you'll go direct to the big fund company and say you want to invest $10,000. But when that happens, I want you to think for a second about what takes place. Now, what takes place is you wire in your $10,000 to the big fund company, let's say at 10 o'clock in the morning. Nothing actually takes place until 4 o'clock at the close of trading. At the close of trading, the fund company has to figure out what its total assets are, how many shares are outstanding, what the net asset value is per share. They have to figure out how many shares you get for your $10,000. They need to write down who you are and what your address is and what your tax information is. They need to send you a prospectus. They need to transfer those shares and settle them into your account. Then they go to sleep. In the morning, they get up and they have your $10,000 that they have to go to work, put to work in the market. So they hire a bunch of analysts to pick which stocks to select. They buy and trade those stocks. And that if you want your money out, they have to do all of those things in reverse. So that's basically how a mutual fund works. Now let's think about how an ETF works. Let's use the same scenario. If you're an investor and you want to put, say, $10,000 to work in an ETF, in this case in SPY, the first ETF, which trades in New York, gives access to the S&P 500. All you do is you go into your Questrade account or your brokerage account, and you put in an order for 100 shares of SPY. You buy those shares from someone else who's selling them on Wall Street, just like if you were buying shares of a single stock. And you get 100 shares at $97.23 a share, and everyone's happy and goes on their way. Now, there are a few things that are different about this slide versus the previous slide. One is that you didn't have to wait till 4 o'clock to make this transaction. You could buy shares at 10 and sell them at 11, and buy shares at 1 and sell them at 2, and buy shares at 3:30. You could do whatever you want. But the big difference on this slide, the big thing that's missing, the key to what makes an ETF an ETF, is that the ETF company doesn't exist. In this slide, you literally have the ETF company literally doesn't know that you own their shares. In the mutual fund example, you sent your money directly to the ETF, the mutual fund company. They went into the market and bought stocks with your cash, and they gave you shares. In this example, you just bought ETFs from another investor who was looking to sell. Now, if you're smart, you're probably asking yourself, well, that seems strange. If the ETF company isn't getting my $10,000, how does the ETF hold anything of value to make it worth investing in. And this really is the key to how it all works. The process by which the ETF comes to hold things that are worth value is called the creation-redemption process, and the key player in that is someone called an authorized participant. And the authorized participant is an institutional investor or trader whose job it is to essentially create or destroy shares of an ETF to meet market demand. In this case, let's imagine that this is an S&P 500 ETF. At the end of every day, the ETF company will publish the exact list of securities it wants to own in the exact percentages it wants to own them. In this example, it's saying it wants to own, say, 3% of Apple and 1% of Cisco and 2% of IBM and 4% of Microsoft, and so on and so forth, all the way down through all 500 stocks that it wants to bring into their portfolio. If the authorized participant wants to create shares of this S&P 500 ETF, they will actually go into the market. They'll take $2.5 million and they'll buy $2.5 million worth of Apple, Cisco, IBM, Microsoft, Caterpillar, and the other 495 stocks in the S&P 500 in the exact percentage that the ETF company wants to hold them. And they'll take those securities and put them into a basket and ship them to the ETF company. It's called a creation basket. In exchange, the ETF company will give them an equal value of shares in the ETF. In this case, the authorized participant has sent $2.5 million worth of IBM, Microsoft, Apple, Caterpillar, and Cisco, etc., which the ETF company gets. And the authorized participant in exchange gets 100,000 shares of SPY, which at this case, let's say, is priced at $25 a share. So it's a perfectly even trade. $2.5 million in stock to the ETF company, $2.5 million in ETF shares to the authorized participant. Now, the same thing can happen in reverse if the authorized participant wants to destroy shares of an ETF. They can go into the market and acquire, let's say, 100,000 shares of SPY, buy them from investors that are looking to sell at, say, $25 a share. They can send those 100,000 shares to the ETF company. In exchange, the ETF company will give them an equal value of the underlying stocks, the Apple, the Cisco, the IBM, the Microsoft, etc., which the authorized participant can then sell onto Wall Street to even out their books. Now, you may be asking, why do these authorized participants do all this work to create the exact portfolio that ETFs want to own, or to redeem out those portfolios and sell them into Wall Street? And the answer, of course, is greed, like most things in finance. The authorized participant is incented to act because ETFs should always trade at fair value to their underlying holdings. In other words, if you have an ETF that holds $25 worth of individual stocks, the ETF should trade at $25, as you see on this example. But let's imagine in this example that someone comes in with a $10 million buy order for this ETF. Well, for a fleeting second, this excess demand for the ETF might drive its share price to a slight premium to fair value. In this case, the ETF share price has gone up to $25.10, but it's still only holding $25 worth of stock. This is when the authorized participant jumps. They sell this ETF that is trading at an inflated value of $25.10. They then hedge their book by buying the equal value of the underlying stocks, IBM, Microsoft, Apple, Cisco, Caterpillar, and so forth, because they know that at the end of the day, they can turn those underlying stocks into the ETF company for an equal value in shares of the ETF to cancel out their short sell of the ETF itself. This action, selling the ETF shares and buying the underlying securities, causes the ETF share price to drop. It puts buying pressure on the underlying securities and pushes them all back in fair value so that the ETF is now trading back where it should, at $25.01 in this case, which is the same value as the securities it holds. The authorized participant in this process has made a relatively risk-free arbitrage profit. In this example, they bought the ETF for $25, they sold it for $25.10, they make a 10-cent profit per share. The same thing, of course, happens in reverse. If there's a big sell order for an ETF, its share price might fall below fair value momentarily. The authorized participant will jump in. They'll buy, in this case, 100,000 shares of that discounted ETF at $24.90. They'll sell short an equal value of the underlying securities because they know at the end of the day they can turn that ETF shares into the ETF company and get those underlying stocks in a redemption basket to balance out their book. Again, they've made a risk-free arbitrage profit. They've driven the ETF share price back in line with the underlying value of its securities, and everyone is happy. So that's the core of how ETFs work. There is an authorized participant. They are tasked with creating and destroying shares of that ETF. They do that by going into the market and buying all the stocks the ETF company wants to hold, or when they redeem, they send ETF shares into the ETF company and get those underlying stocks, which they then sell on the open market. Now, it's important to go through all this because all of the benefits and all of the risks that you hear about in the ETF market are driven by this creation-redemption mechanism. It's the source of everything that's good about ETFs, as well as everything that makes ETFs slightly risky and more difficult to deal with. So let's talk about that for a little bit. Why do ETFs work as trading tools when closed-end funds, which have been around for much longer, don't? It's because this creation-redemption mechanism keeps ETF prices fair. So for 99.9% of all ETFs, if you were to look at any given moment in time, you'd see that they would be trading at a tight band to fair value. And that's because authorized participants are incented to eliminate any distortions that might pick up. Now, there have been instances in the past in highly illiquid markets or during times of high volatility when these prices can get slightly apart, but they always snap back over time. And the reason, again, is that creation-redemption mechanism. Let's talk about costs. The average fee for a mutual fund in Canada, according to Morningstar, is 2.2%. The average fee for an ETF is 0.34 basis points, according to Richardson GMP. Why are ETFs so much cheaper? The answer, again, has everything to do with how they function. So one reason they're cheaper is they tend to be index funds. That's a big course. Another reason they're cheaper is because they are exchange traded, they're able to avoid the distribution fees that get layered into traditional mutual funds. But the third reason they're cheaper, and the reason that on average retail ETFs are cheaper or as cheap as institutional index mutual funds, is because they're just cheaper to run. Think about everything that had to happen when you invested in that mutual fund. You had to wire them money, they had to write down who you were, they had to take your tax information, they had to send you a prospectus, they had to hire analysts, they had to trade stocks, they had to undo all that when you wanted to come out of the fund. With an ETF, you're just buying that ETF from another investor through your brokerage account. All of that record keeping, all of that manual labor is outsourced and borne by the brokerage. Moreover, even some of the portfolio management is outsourced in that process because the main way that ETFs acquire securities is through this creation and redemption process, this in-kind process. The authorized participants are actually doing the bulk of the buying and selling for the ETF company itself. Now, ETFs still have work to do, and they still have ETFs don't run themselves, but as the data show, they are substantially cheaper. ETFs cost fund companies less to run, so they cost investors less to own, and that's a very good thing. A third benefit I want to talk about is tax efficiency, and I should say that this comes with a caveat in Canada. First, let me talk about the main issue of tax efficiency within ETF portfolios, and then I'll talk a little bit about the tax treatment of ETFs per se. So within ETF portfolios, one big concern investors have is do funds generate capital gains just by their turnover? And this chart is U.S. data because it's the only data I could find, but it looked at the average capital gains distribution across 7 different areas of the market for active mutual funds, passive mutual funds, and ETFs. And you can see active mutual funds have significant capital gains distributions. Even index mutual funds have reasonably significant capital gains distributions, and ETFs rarely make any capital gains distributions at all from their internal portfolio management activity. And the reason for this is pretty simple. For one, when I sell shares in a mutual fund, it actually has to sell securities to give me cash. When I sell shares as an individual from an ETF, I just sell my shares to another individual investor, and the ETF doesn't have to take any action. But the bigger reason is that redemption process. When authorized participant redeems shares of an ETF, the ETF can look at its individual securities that it owns and choose the ones with the most embedded capital gains and pass those on to the authorized participant. In so doing, they're able to cleanse the portfolio of potential capital gains repeatedly. And this is the reason why, at least in the equity space, ETFs almost never take capital gains distributions, as this chart shows. And this data, although it is only from 2001 to 2011, has repeated or at least rhymed in the next 7 years and across every major geography. The caveat I want to mention here, which you all know very well, is that there is an issue of withholding tax and differential treatment of dividends and capital gains, particularly for Canadian-listed ETFs. The tax treatment is complex. It depends on which sort of account you're using, and I don't want to provide specific advice, but suffice it to say that it behooves you to pay attention to which kind of ETF you're using in which kind of account, whether you're using U.S.-listed or Canadian-listed ETFs, because the tax consequences can be very different. I want to talk about benefit 4 for a minute. ETFs get a lot of credit for being more transparent than traditional mutual funds, offering often daily disclosure of their full portfolio compared to the periodic disclosure that mutual funds offer. The reason isn't because ETFs are inherently value transparency as a benefit. It actually has to do with that same creation redemption mechanism. You can't publish the list of securities you want to bring into the fund or that you're going to give out in a redemption basket without effectively telegraphing what's in your portfolio. And as a result, the vast majority of ETFs disclose their full portfolio every day. The last one I wanted to touch on is continual improvement. And this, again, is U.S. data because I didn't have Canadian data, and the U.S. industry has a longer continuous track record for its funds. But I did want to point this out. We've heard a lot about the fee wars in ETFs taking place in every major geography where ETFs exist, and that's definitely the case. But some people understate the impact of this. This looks at the first ETF to launch in each of 6 major categories: U.S. equity, developed markets, emerging markets, fixed income, real estate, and commodities. And you can see when those products launched, their fees were really cheap. 16 basis points for U.S. equities, even 75 basis points for emerging markets when it's launched was considered revolutionary. But if you go to the right, you can see that the costs have come down between 67 and 89% for access to those areas of the market. It's hard to think of anywhere in finance or indeed in almost any consumer technology that has faced that kind of price depression and disinflation over the last 20 years. That is just remarkable. And the reason for this is that there are huge network effects to ETFs. In traditional active mutual funds, bigger isn't better. In fact, most studies suggest that smaller active mutual funds perform better than bigger ones because bigger ones run into opportunity constraints. They end up hugging the benchmark because that's the only place they can find liquid exposure. ETFs, by converse, are completely scalable, it is basically just as easy to run a $10 billion ETF as a $1 billion ETF. Moreover, as more people get into the fund, the trading increases, spreads tighten up, tax efficiency improves, and so there's this wonderful effect in the ETF space that as it gets bigger, and it's getting much bigger very quickly right now, the ETFs come down in cost, they go up in liquidity, spreads come in, and tax efficiency improves. So continual improvement is a big benefit. I do want to touch briefly on some issues and then run into how to evaluate ETFs before we open it up for questions, because not everything is rosy in ETF land. This is a chart of a U.S. ETF in 2010 during the so-called flash crash. You can see that this equal-weighted S&P 500 ETF traded happily along at 41 before crashing all the way to 0 and then rebounding. If you had been in a mutual fund on this day, the flash crash didn't happen to you. A lot of the benefits you get from ETFs, a lot of the reasons they're cheaper and more tax efficient is because they're traded on exchange. But as an investor, that puts a burden on you to understand how to trade securities on an exchange. You have to know how to buy them. You have to know how to sell them. You have to know not to use sleeping stops so you don't get stopped out if we have another flash crash. It puts the burden on the individual, whereas a mutual fund, because it only prices once a day, at the end of the day with no time pressure, takes all that burden away. So the savings you get from an ETF come with a cost, which is the complexity of trading on exchange. Another benefit is, or another risk is commissions. When you put ETFs on exchange, you do have to pay commissions when you trade. And yes, there are plenty of zero-cost commission programs, both in Canada and elsewhere, but most of them come with fine print. No one gives away anything for free, and whether those are account balance fees or suboptimal money market funds or other factors, you have to look and understand how you're paying for these zero-cost commissions, because at some point you are. A few more issues before we get into evaluating ETFs. I mentioned spreads. Even with zero-cost commissions, you still pay a spread entering and exiting an ETF. You don't do that with a mutual fund. Some spreads are small, a penny wide. Some are 4% or more. So you just have to be careful and consider spreads as one of your major costs. Another issue can be fair value. Most ETFs trade close to NAV, but funds can get out of balance. So again, it's a burden on you as a person executing these trades to understand how you evaluate fair value and decide if it's something you need to keep an eye on. Two more issues: ETF expectations. ETFs have opened up complex areas of the market. This is an example of a natural gas ETF. You can see over the time period we looked at here, about a 5-year time period, the light blue line, which is spot natural gas, was up about 25%. The dark blue line, which is the U.S. natural gas ETF, was down more than 50%. And I raise this simply because ETFs have made it extraordinarily easy to buy things like commodity futures. And people can get confused and think they're buying the spot commodity price. So one virtue of ETFs is they've opened up sophisticated investments to every investor, and that is also a risk. But the last risk I want to talk on before we open it up, before we go through how to evaluate ETFs, is this one. This is a chart that looks last year at the difference in performance between about 10 China equity ETFs listed in the U.S. And we'll give some Canadian examples later, but the same story repeats there. And you can see that if you picked that top line, the WisdomTree state-owned state-owned enterprises ETF, you would have been up more than 80% on the year. And if you picked one of those two bottom lines, maybe the VanEck China AMC or the Deutsche Bank CSI 300, you would have been up about 30% of the year. The difference between 80 and 30% is a lot, and these are all plain vanilla Chinese equity ETFs. And to me, this is the biggest risk in ETFs, is how you evaluate and choose and make sure you're getting the exact exposure you want. So let's move on to the last section of the talk before we open up Q&A and talk about that. Talk about how you evaluate ETFs and choose the best one every time. Now, I wish I could tell you that there was an easy button, that simply buying the largest and most liquid ETF was the right choice, that you could trust the wisdom of the crowds. But the history of the ETF land is littered with examples where that's not the case. So it's definitely not the case that in that China example I gave, the largest ETFs were the best performing. It's not even the case that they gave you the best exposure to the Chinese market. Often the first ETFs in any given area give you the easiest exposure, and China is a great example. The first ETFs in the China space owned, I think it was 25 large-cap Chinese equities, mostly state-owned enterprises, no exposure to the entrepreneurial class, and no exposure even to A shares listed in China itself. The space has evolved, so you now can get exposure to all of those things, but unfortunately they're not yet the largest and most liquid ETFs. So there is no easy button. So how do you choose? Well, when I was at ETF.com, we developed this ETF Rating Methodology, which I still think is the right framework for evaluating ETFs. And it's to ask yourself effectively 3 questions. Efficiency, in other words, does this ETF do what it says it does? Can I trust it? Tradability, can you trade it? And then fit, which is where you have to get personal and ask yourself if this is giving you the exact exposure you want. So what do I mean by efficiency? And this is a slide taken from ETF.com, which provides this analysis for free for U.S. listed ETFs. This is now FactSet data. I know that FactSet is working on exporting this to Canada as well, so this sort of framework should be available soon. So when you talk about efficiency, you're really talking about a couple of things. 1, are there any hidden risks in this ETF that will blow up? But 2, and more importantly, what is the expense ratio and how well does it track its index? And I would just point out that those things aren't always obvious. Here's a look at 2 S&P TSX 60 ETFs. The first one, Horizons, has an expense ratio of 7 basis points. The other one, iShares, has an expense ratio of 15 basis points. You might expect their returns to be gapped by just 8 basis points. In fact, on the trailing year, you can see that the gap is actually 22 basis points. Now, 22 basis points may not seem like much, but it's worth paying attention to in a world where we're only expecting 5 to 7% returns. It's a significant chunk. How are these funds delivering different returns? Well, it's not child's play to track an index. You have to correctly trade stocks as they enter and exit that index. There are questions about how you put dividends and things to work. Some funds engage in securities lending activity that adds revenue. There's some variability in how funds trade and add new securities. So you just have to remember expense ratios aren't everything. And this is a small example, but there are many examples of ETFs that do a much wider variance in how they track. So efficiency, look at expenses, look at tracking, and look at any hidden risks that might lurk in the portfolio below that. Then you have to get yourself to tradability. Even if this is the best ETF in the world, if you can't trade it, it doesn't do you any good. This is a screen grab of the tradability analysis for an ETF, and I just point out there are really 2, maybe 2.5 things to consider in tradability. The first thing is pretty obvious. You look at the average daily share volume and the average spread, and you want to see high trading volume and a relatively tight spread. That's particularly true if you're buying 100 or 1,000 or a couple thousand shares of an ETF. But if you're buying more than that, it actually becomes more important how liquid the securities that the ETF owns are than the securities of the ETF itself. In other words, if you had an ETF tracking the TSX 60, and that ETF only traded a few hundred shares a day because it just launched, you could probably still buy it and probably still get a good price, even if you wanted to buy, let's say, 100,000 shares. Because remember, there's always this authorized participant that's looking to create new shares of an ETF. If you had a single stock that only traded a few hundred shares a day, trading 100,000 shares would be impossible. But with an ETF, the authorized participant can always create more shares to meet demand. So the way that FactSet looks at this, They look at this 1 to 5 score, which evaluates how easy it would be to trade $1 million worth of this ETF. But you can also just think of it intuitively. If an ETF holds liquid securities, you should be able to trade it even if its on-screen liquidity is poor. You just have to know how to work with a market maker, or you have to know how to manage limit orders so you can get those trades done extremely well. I'd also remember that trading is a big part of your cost. A lot of people get hung up on just the expense ratio, but of course there are other pieces to keep in mind when you're evaluating ETFs. You have to consider the expense ratio, you have to consider the tracking, you have to consider the spreads you might pay, the commissions you might or might not pay if an ETF is in a commission-free platform. And when you put all that together, you get your full cost for owning this ETF. And you'd be surprised that you might get a different answer on what is the cheapest ETF if you just look at the expense ratio compared if you add up all the various costs involved. So that's the T, tradability. The last piece is fit, and fit is personal. With fit, you're asking, does this ETF give me the exact exposure to the market that I want? So you want to look at the sector breakdowns. You want to look at the size breakdowns. You want to look at value statistics like price to earnings and price to book. You want to look at how it tracks versus a market cap weighted exposure. You want to look at the geography and country breakdown. I'll go back to that China example. Some of the China ETFs that performed worst in the example we gave were ETFs that hold market cap weighted indexes of China, mostly focused on government-owned securities like banks. It turned out that last year there was a lot of concern about these state-owned enterprises. The ETF that performed the best was a Wisdom Tree ETF that excluded state-owned enterprises. It only held securities that operated in China's private economy, and those tended to be more entrepreneurial, more tech-focused, and they more focused on the consumer, and the difference in returns was significant. So in the ETF space, just because it's an index-based product doesn't mean that all indexes are created equal, and you really have to dig in. I'll give just one more example in the gold miner space. I looked at all the available gold miners that trade in the U.S. Because the data was easier to get, and traced back 750 days. Had you searched and bought one gold miner ETF, this is the Sprott Gold Miners ETF, you would have achieved about a 15% return over that time frame. Had you bought this ETF, the Global X Gold Explorers ETF, you would have earned about an 80% return. That's a 70% gap in just 3 years of trading. And of course, you could have been anywhere in between. Here's a look at all the different patterns of returns, ranging from 80 to 50 to 30 to 20 to 10. Now, I can't tell you with certainty that you would have picked the top performer here. But what I can tell you with certainty is that with even 5 to 10 minutes of analysis, you could have realized the primary differences between these portfolios, realized if they were focused on established companies or junior explorers, realized that their index construction methodologies were different, and you could have found the one that at least gave you the exposure you were looking for. And that's all you can hope for, right? So again, 3 easy ways to think about it: efficiency, tradability, and fit. Can I trust it? Can I trade it? Can I do better? I just close with one concluding thought before I turn it over to John for some questions. I like to put up this slide. This is an example of what ETFs can do. This is what I call the world's lowest cost ETF portfolio. It holds the cheapest ETF in each of 6 asset classes: U.S. equity, developed markets, emerging markets, FICSI, REITs, and commodities. It gives you exposure to over 3,000 stocks, 40 different countries, well more than a dozen different currencies, a full suite of 20-plus commodities, dividend anchor in the REIT space, and the blended all-in costs of this portfolio are 0.05%. So compare that, a portfolio that an institution would have killed for just a few years ago, to the average fee of 2.2% for a mutual fund, which tends to underperform its benchmark regardless, and it's a remarkable deal. If you look in Canada, you get a slightly different portfolio. This is one I built with just Canadian-listed ETFs. If you don't want to own U.S.-listed ETFs, put a 20% weight in Canada, the rest of the exposure in U.S. equities, developed market equities, emerging markets, fixed income, REITs, and gold. Again, massive diversification, thousands of companies, hundreds of bonds, an anchor in the gold space, significant yield from the REIT space, and the blended expense ratio here is just 0.14%. That's remarkable. And with that, I guess I would turn it over to my good friend John Swolfs. We have 5 or 7 minutes left for questions. Anything come in, John, that you want to tackle?
Yeah, absolutely, Matt. And first of all, thank you for taking the time to join us and go through that presentation. It's always very educational, even if we have heard it a few times from my seat. I always pick up something new, so thank you for that. So the one question that came in, Matt, that people are talking about is within that, fit, tradability, and efficiency, does that same framework apply to fixed income, to leveraged ETFs? Can you just use that broadly to evaluate any ETF?
That's a great question. That is a fantastic question. I will say that the first two things apply to every ETF. You always want an ETF that's efficient. You always want an ETF that you can trade. Those are absolutely critical. The fit thing is different. The fit thing is personal, and it has to do with the exposure you want. So you brought up leveraged ETFs, and of course the trick with levered ETFs is that they are fantastic for holding for a single day, but as you hold them over time, the returns you get aren't the returns you expect. So in that case, you have to truncate fit to fit your needs. If your need is levered exposure for one day, then doing a fit-based analysis makes sense. But if your need is exposure that stretches over a very long time, you should probably have discarded levered ETFs at the start because they're really designed for short-term holding periods. So my short answer is yes, efficiency always, yes, tradability always, and yes, fit always, but you have to think about what your goals are with this strategy before you jump in.
Yeah, absolutely. So always good to look at your strategy before you do jump in to the market. So Matt, I wanted to go back and touch a little bit on the flash crash there, because you mentioned that you wouldn't have had that experience in a mutual fund. And the question is, why would you not have had that experience in a mutual fund?
Great question. So the mutual fund manager might have had it, but the thing about mutual funds is they only price once a day. They literally strike a net asset value at the end of every day. And so that price doesn't update during the day. As an individual investor, you didn't have a chance to sell out of your mutual fund. The risk with an ETF is that its price, updates tick by tick. So I literally meant a mutual fund investor wouldn't have experienced it because their net asset value on Tuesday would have been $49, and their net asset value on Wednesday would have been $49, and there was no intervening price. It's just because ETFs trade on an exchange that they experience things that equities, traditional equities experience. And that's totally fine. It just puts the burden on you as an investor not to panic and to understand how those markets work. It's as simple as that.
Right, and I think the key takeaway there is that you said that the mutual fund manager, he still would have been experiencing that as his portfolio that owns stocks would have been going up and down, and he would have had to control his emotions to not sell as well. So good 100%. Point to take out of there as well. Yeah.
100%. Yeah. And hopefully he did.
Yes, absolutely. So we have a question here. What do you think of the ETF trend that's happening in 2018, especially around robo-advisors, and in that space, kind of how do you see that trend taking place and continue to grow in 2018, if at all?
Yeah, sure. So I'll answer it a couple different ways. One, I'm a huge fan of robo-advisors. I use one myself to manage a good portion of my own assets. So I think they do a fantastic job at providing plain vanilla exposure. I think that trend is not going away, and they'll eat a large portion of the lower end and younger parts of the market. I do think the best combination for most investors is to pair a robo-style underlying with human financial advice on top that can provide either customization, or behavioral coaching or financial planning to clients. So I think the growth of robo as part of an advisory practice is a trend that will never go away, and I think it will be the dominant way people manage money 5 years from now. But I think most of it will be managed in conjunction with a human advisor that provides behavioral guidance and coaching, at least for the foreseeable future and for a large portion of the population. There'll be other people who are happy with just the robo front end, and that's it. But I think there's probably the bionic advisor is where this is all going.
Gotcha. So we have time for one last question, Matt, and it has to do around the fixed income space. We've seen a lot of innovation in equity ETFs and so-called smart beta and all these different types of options that are available to investors. Do you really see any kind of new fundamental changes within the way fixed income ETFs are built, and will that be a good outcome for investors?
Actually, I do. I'm actually much more bullish on smart beta and active strategies in the fixed income space than I am in the equity space. I'm fairly convinced in the equity space that it's extraordinarily hard for managers to add value from an active perspective. But fixed income index exposures are dumb, right? They invest the most amount of their money in the most indebted securities. And I think even simple rules-based strategies that just trim around the edges of traditional fixed income indexing can create better performance results for investors. So, if I project out, look at the ETF industry 5-10 years from now, I think 90% of the assets in equities will be still traditional indexed, and smart beta will be around the edges. I think in the fixed income space, it actually could be closer to 50-50, even within ETFs, with both smart beta strategies in fixed income and straight active taking significant shares of exposure. And I will say, particularly in corporate bonds, there are a number of smart beta strategies out there today that I really like, that take into account either existing scoring of credit quality or novel approaches at evaluating issuers' willingness and ability to pay, that I think will probably be a better way to gain exposure to the corporate space for the foreseeable future. So I'm more excited about fixed income ETFs than I am about equity ETFs. I think it's going to be even more dynamic and exciting, and I can't wait to see it unfold.
Well, with that, Matt, we are just out of time here, so I want to remind everyone to join us again next week at 2 p.m. as we continue our Canadian ETF University with ETFs 201, How to Trade ETFs Like a Boss, where I will be joined by Roger Chanhook and Frederick Vigor of National Bank to walk us through how to effectively trade ETFs. Again, thank you to Matt Hogan for joining us today. A big thank you to all of our attendees for dialing in. And I'd like to remind you that you can go to www.InsideETFs and register for our first ever Canadian conference that will be taking place this June 21st and 22nd in Montreal. So again, that's www.InsideETFsCanada.com, and you can register today. We have a fantastic speaking lineup. We have a robust agenda, and it's really going to be a great conference. So I would encourage anyone on this call to go ahead and get themselves registered and book their room down in Montreal. But with that, from all of us here at Inside ETFs, have a great day, and we'll see you next week. Thank you.